The trade war is back. China announced new tariffs on U.S. goods. These tariffs are 34%. They will hit all U.S. products entering China. This retaliation is significant. It comes after the U.S. imposed its own tariffs. The U.S. now has a 54% tariff on Chinese goods. This tit-for-tat escalation has spooked investors globally. The timing couldn't be worse. The global economy is already fragile. Inflation remains stubbornly high. Interest rate hikes from central banks are slowing growth. This trade war adds more uncertainty. It injects fear into the markets. Businesses now face higher costs. Consumers will likely pay more for goods. The impact was immediate and severe. Stock markets worldwide tumbled. The Dow Jones Industrial Average plunged over 1,300 points. This is one of the worst drops in recent history. The tech-heavy Nasdaq fared even worse. It slid by 6%, entering bear market territory. This means it has fallen more than 20% from its recent peak. The situation is deeply concerning. These tariffs threaten to derail the global economic recovery. They could spark a full-blown trade war. This would damage businesses and consumers alike. The world is watching nervously. We need cool heads to prevail. It's time for dialogue and de-escalation. The stakes are simply too high to ignore. The Dow Jones wasn't alone in its freefall. The S&P 500, a broader measure of the U.S. stock market, also took a significant hit. It shed nearly 3% of its value, wiping out billions in investor wealth. The Nasdaq's plunge was particularly alarming. It signifies a loss of confidence in the tech sector, a key driver of economic growth. The fear is palpable. The VIX, Wall Street's fear gauge, spiked to its highest level in nearly a year. This index tracks the volatility of options on the S&P 500, and its surge reflects the heightened anxiety among investors. They're rushing for the exits, seeking safety in traditional havens like government bonds. The 10-year Treasury yield, a benchmark for borrowing costs, dipped below 4%. This drop indicates that investors are flocking to the perceived safety of U.S. government debt. They are willing to accept lower returns in exchange for security in these uncertain times. The pain wasn't confined to North America. European markets followed suit, with the STOXX 600 index, which tracks major companies across Europe, tumbling by almost 2%. Banking and mining stocks, highly sensitive to global trade flows, were among the hardest hit. The interconnectedness of the global economy means that trouble in one region quickly spreads to others. The trade war's impact is already being felt in corporate boardrooms. Apple, a bellwether for the tech industry, and a major importer of goods from China, saw its shares plunge. The iPhone maker relies heavily on Chinese manufacturing and faces higher costs due to the tariffs. This double whammy of increased expenses and potential demand slowdown in China spells trouble for the tech giant. It's not just tech giants feeling the heat. JP Chase, one of the world's largest banks, downgraded its outlook for industrial giants Dow Chemical and LyondellBasell. These companies are heavily exposed to the Chinese market, and the tariffs threaten their export businesses. The uncertainty surrounding trade makes it difficult for businesses to plan and invest, further dampening economic activity. The chilling effect on the markets is undeniable. Several high-profile tech IPOs, including those of Klarna, StubHub, and Chime, were postponed. These companies were hoping to capitalize on investor appetite for growth, but the market turmoil has forced them to reconsider. The window for successful IPOs can be fleeting, and these companies are now left in limbo. Even in the volatile world of meme stocks, the trade war cast a shadow. GameStop, the video game retailer that became a symbol of speculative trading frenzy, saw its shares rise. This counterintuitive move suggests that investors might be seeking refuge in familiar, albeit risky assets amid the broader market turmoil. The escalating trade war has economists and market analysts deeply concerned. JP Morgan's chief economist warned that the probability of a global recession has risen to 60% if these tariffs remain in place. This stark warning highlights the potential severity of the situation. The trade war could push the global economy over the edge. The sentiment is echoed by other experts. Bob Dahl, chief investment officer at Crossmark Global Investments, predicts further market declines and places the odds of a recession at 50%. He points to the tariffs' negative impact on business confidence and consumer spending as key factors contributing to the economic slowdown. Bleakley Advisory Group's chief investment officer Peter Bukvar warns that a decline in high-income consumer spending, triggered by the falling stock market, could be the tipping point for the U.S. economy. This segment of the population accounts for a significant portion of consumer spending, and their pullback would have a ripple effect throughout the economy. The uncertainty surrounding trade policy is a major concern. BlackRock's Rick Ryder emphasizes that businesses thrive on predictability, and that the current environment makes it challenging for CEOs to plan for the future. This uncertainty can lead to businesses delaying investments and hiring, further exacerbating the economic slowdown. The trade war is a dangerous game, and the consequences of continuing down this path could be dire. It's time for world leaders to come together and find a solution that benefits everyone, not just a select few. The future of the global economy hangs in the balance.